This chapter is on balance of payment. It is chapter number 12 of your CBSE syllabus. And this chapter talks about balance of payment, and the components of this chapter are meaning of balance of payment, meaning of balance of trade, components of balance of payment, autonomous and accommodating items, and we'll conclude the lesson with deficit in the balance of payments or a disequilibrium in the balance of payments. To begin with, let us understand the term balance of payment. Balance of payment has certain terms in its definition which are mandatory while we understand what is balance of payment. First is it is an accounting statement. And second important term is it's a systematic record. Okay? And the next important term is record of economic transactions only. And these transactions are between the residents of the country and the rest of the world. In the earlier classes, we have done who are the residents of the country and who are the exceptions to the residents of the country, and this is for a given period of time. So these words, these five letters, assert, will help you to ensure that you put all these words when you are defining balance of payments. So what is it? It is an accounting statement which provides a systematic record of economic transactions between the residents of the country and the rest of the world in a given period of time. Now, from this, we are going to further explain what are economic transactions and who are the residents of the country. So before we explain what are economic transactions, first we need to explain who are the residents of the country. We have earlier studied that residents of the country include, number one, individuals, it includes firms, and it includes government agency. But residents do not include diplomatic staff, it does not include foreign military personnel, it does not include tourists, it does not include migratory workers, it does not include branches of foreign companies. These all are not included as residents of a country. Only individuals, firms, and government agencies are part of residents of a country. So this part is clear. The A means accounting statement. Basically, it's showing the transaction between one person and the other person. And now moving on to the economic transactions. So economic transactions are those transactions which involve transfer of title or ownership of goods, services, and money assets. And there are four categories of economic transactions. These are visible items, second one invisible items, third one unilateral transfers, and fourth one capital transfer. So first component of economic transaction includes visible goods. So what are visible goods? These are physical goods. All types of physical goods are categorized as visible items, and these items can be exported or imported. Something very important, they are like your volume. This is made up of matter and that can be touched and measured. These are what is known as visible items. They are made up of physical goods, occupy space, they can be exported or imported, and they can be touched and measured. The next category of economic transactions are invisible goods. What are invisible goods? Invisible goods are those goods which include SBI. S standing for shipping, B stands for banking, and I stands for insurance. These invisible items cannot be seen, they cannot be felt, touched, or measured, unlike the visible items which can be touched or measured. So remember this abbreviation, it will help you to remember that these goods include shipping, banking, and insurance. These goods cannot be seen, felt, and touched or measured, unlike visible goods. The third category of economic transactions include unilateral transfers. So what are unilateral transfers? Unilateral transfers are those transfers which are one-sided transfers, one-way transaction. That means if you are giving a gift to someone, you should not expect that some gift will come in return. So there's one-way transfers. If you are sending money to your parents, grandparents, these are all one-way transfers, and they are also called as unrequited transfers. These are called unrequited transfers. The fourth category of economic transactions are capital transfers. They comprise two components. One is capital receipts. Capital receipts you get through borrowings. You are getting something in return, and when you sell something, selling of assets will also help you to earn capital receipts. The second component of capital transfers is capital payments, and this comprises capital repayments, and if you purchase something you have to again pay something in return. So these two components are the components of capital transfers. Capital transfers has two components. Number one is capital receipts, which you get through borrowing and sale of assets, and the second one is capital payments, which you have to pay because of capital repayments or purchase of assets. So what do we mean by structure of balance of payments? Structure of balance of payment has double entry system. What do we understand by the term double entry system? The term double entry system means that it has a credit side and it has a debit side. So it's double entry means that for recording any kind of transactions between a country and the rest of the world, BOP account has two sides. The first side is the credit side, or the second side is the debit side. So anything which we are selling and we are getting money in return, that means all inflows will be recorded on the credit side. All inflows and all sources of foreign exchange will be recorded in the credit side. So what does the debit side mean? Debit side means something which is going out, or your uses of foreign exchange, they will be recorded in the debit side of the structure of balance of payments account. So what do we have to understand over here? We have to understand very clearly that BOP is a double entry system. The transactions are recorded on two sides. One is the credit side and the second is the debit side. Credit side meaning inflows, something which you are earning, and debit side meaning outflows, that means something which is getting out of our pockets. Let us read these examples of transactions on the credit side. If we are exporting goods and services, so you will get something in return, you will earn something in return, so it will be recorded in the credit side. If we are importing goods and services, you have to pay something in return, so something will be getting out of our pockets, so it will be recorded in the debit side. The next example is income received from abroad. When you receive the income, it will be recorded in the credit side of transaction, and if you pay the same income abroad, it will be recorded, something is getting out from our pocket, so it will be recorded in the debit side. Transfers from abroad will be recorded in the credit side, and transfers to abroad, that means you are sending something to abroad, that will be recorded in the debit side. Take the next example. Increase in external liabilities will be recorded in the credit side. You are earning something of it. Then decrease in external liabilities is another example. It will be recorded in the debit side. Take another example to make the concept clear. Decrease in external assets. Why will it be recorded? You are selling them off and you are getting something in return. It will be recorded in the credit side. Increase in external assets. Suppose I buy something in Dubai, I have to pay from here. So something is going out from my pocket, so it will be recorded in the debit side. So to repeat again, the structure of balance of payments is a double entry system, and it records the transactions on the credit and debit side. Credit side meaning inflows and debit side meaning outflow. Balance of payments can be of three categories. The first category of balance of payments is balance of payments. So before we understand the definition, we must keep in mind what are the things which we are balancing in the balance of payments, or what are the terms which we are using in the BOP. So remember, we are using the terms in the BOP as receipts and payments. The two terms which we are going to use in order to explain balance BOP or surplus in BOP or deficit BOP, these two terms which we are going to use is receipts and payments. So when do we say that balance of payment is balanced? When receipts of foreign exchange is equal to the payments of foreign exchange, it is said to be balanced balance of payment. Then what is surplus in BOP? Surplus in BOP will again be defined in terms of receipts. Surplus means you are having more. So when receipts of foreign exchange are more than the payments of foreign exchange, then it will be considered as surplus of BOP. The third type of balance of payment is deficit in balance of payment. Again, we'll be using the term receipts and payments to define deficit in BOP. So in case of deficit in BOP, you are paying more than you are receiving. So payments are more than the receipts. So there is a deficit in balance of payment. So children, there are three types of balance of payment. One is balanced balance of payment. The second one is surplus balance of payment. Third one is deficit balance of payment. And remember, these terms would be defined in terms of receipts and payment. In case of balance, it is equal. In case of surplus, receipts are more than payments. In case of deficit, payments are more than receipts. After having studied the term balance of payment, our next task is to understand the term balance of trade. And we will just repeat that balance of payments we explained in terms of receipts and payments, but balance of trade, children, we will be explaining in terms of exports and imports. So explaining the term balance of trade, it is just the difference between the amount of exports and the total amount of imports. And please remember, we are referring to visible items. We are referring to visible items. So balance of trade, if you have to express it in terms of a short formula, it is export minus import, but export minus imports of visible goods. Just as receipts are recorded in the positive side, that is the credit side, and payments are recorded in the negative side or the debit side. Similarly, exports, when you export, you earn something, so it will be recorded in the credit side. When you import, you are paying something, so it will be recorded in the debit side. So if exports are equal to imports, there is balance in the balance of trade. This is very rare phenomena. Either you have a surplus BOT, that is balance of trade, or you have a deficit BOT. When do we have a surplus BOT? When exports of goods is more than imports of goods. Please remember, we are talking about visible items only. So when exports of goods is more than the imports of goods, it is considered as surplus balance of trade. And what is deficit balance of trade? Deficit balance of trade is when imports of goods, that means you are paying more than what you are earning through exports. In that case, the balance of trade is considered as deficit in the balance of trade. So just a recap for balance of payment, please remember it is receipts and payments terms which we are using to explain BOP, and for balance of trade you are using the term exports and imports to explain the term BOT. Having understood the two terms, the balance of payments and balance of trade, it is now time to distinguish both these concepts and prepare ourselves well for a question on difference between balance of trade and balance of payment, keeping in mind exports and imports, and keeping in mind over here receipts and payments. So what is balance of trade? It is nothing but the difference between exports and imports. When you are learning, put exports and imports of visible items only. But what about BOP? It's an accounting statement, a systematic record, economic transaction between residents of the country and the rest of the world in given period of time. So your ASERT, that definition of the definition with which we started, that is the balance of payment, we are repeating over here. And we also understood that balance of trade is only considered for visible items, and visible items are those items which can be measured, touched, they occupy space. But balance of payment includes all the four categories: visible items, invisible items, just to remember SBI, shipping, banking and insurance, unilateral transfers, one-way transfers, and capital transfers, which includes two components: capital payments and capital receipts. The fourth distinguish between balance of trade and balance of payment is it does not record any transactions of capital nature, but it records, in case of balance of payments, it records all transactions of capital nature. The next point is regarding scope. Because it includes only visible items, it's a narrow concept. It is a wider concept than BOT because it includes all the four components: visible items, invisible items, unilateral transfers and capital transfers. Unfavorable BOT. It's a narrow concept. Then how do you expect that BOT can check the unfavorable BOP? So unfavorable BOT can be met out of favorable BOP, but unfavorable BOP can't be met out of favorable BOT. Please remember, it's a narrow concept. It includes only visible items. So if there's unfavorable BOP, then favorable BOT will not be able to meet out the unfavorable BOP. All transactions of the BOP can be broadly classified into two accounts. One is current account and the second one is capital account. First one is current account, second one is capital account. So now we'll be studying about the components of current account, and then we'll be going into details about component of capital account.